Hello everyone. My name is Rachel, and today my presentation topic is loan versus EMI versus credit card. What's the smartest way to borrow? What is borrowing? The act of receiving money from someone's, usually a bank or a lender, with a promise to repay it later, typically with interest. Refers to the concept of borrowing money or taking out a loan. Uh, this means you are given a certain amount of money to use right away. The money doesn't belongs to you. It is provided temporary by someone else. The person or institution giving the money is known as the lender. Common lenders includes bank, credit unions, or online lending companies, or private individuals. The person you're borrowing, in simple words, borrowing allows you to access money now and repay it over time. It helpful in both personal and business setting. Here, the person who received the money is the borrower. When you borrow money, you agree to pay it back in the future. This agreement is usually formalized through a loan contract. Repayment is often made in installment or in one lump sum or on a certain date. Interest in the extra amount of money you pay on top of the amount you borrowed. It is the lender's way of earning money or letting you use the money. Why do we borrow actually? For like emergencies, borrowing money during unexpected situations when you don't have enough savings to cover the cost. Like for example, medical emergency, like surgeries or hospitals bills, or urgent car or home repair, or travel expense due to family emergencies. Why it makes sense? Because the emergencies don't come with warning, or it can help you avoid delaying treatment or repair that might get worse, and it can be more expensive. Next to, like, to manage lifestyle expenses, like sometimes people borrow money to maintain or improve their day to day life living standard, even when their income is not enough. For example, paying for a vacations or a holiday, or buying clothes or electronics, or covering monthly bills during tough financial time. Like, we have to be cautious about borrowing. Should be managed carefully. Like relying on too much on loan or credit card for lifestyle spending can lead to debt problem if not prepared on time. Or you can say for asset purpose. Like large purchases, like cars or home appliance, can be very expensive. Borrowing allows you to pay for them over time. Like for example, taking out a car loan to buy a vehicle, or using consumer finance, or a buy now pay later service for a refrigerator or washing machine. The next can be for building credit history, like borrowing money and repaying it responsibly, like helps build a positive credit history. For example, getting a credit card and using it for safe small purchases, then paying the bill in full, taking a small personal loan and repaying it on time. Like, importance of choosing the right borrowing method. So first one is concept cost impact. Like wrong method may lead to high interest rates and hidden fees. Like different types of loans come with different interest rate or fees and repayment terms. If you choose the wrong method, you might end up paying much more than necessary. The second is score risk. Like missed payment on high credit usage can lower your score. Means when you borrow money, your repayment behavior is reported to credit. Later, payment or high credit usage negatively affect your credit score, which can limit future borrowing options. The third one is debt trap. Like a poor choice can lead to borrowing more to repay old loans. Means if you choose loan with short repayment term, like high interest or penalties, you may struggle to repay them and be forced to borrow again just to keep up. This is called like a debt trap, or you can say debt cycle. The next is a mismatch with needs. Like using the wrong type of loan for a specific purpose can create financial strain. Means not all borrowing options are suitable for every situation. Like choosing the wrong loan for your needs can lead to high cost, long terms, or unnecessary stress. The fifth one is financial health. Like right method ensures manageable repayment and long-term stability. Means when you choose the right borrowing method, your payments are affordable and your overall finance stays balanced. This helps you avoid like stress and meet your long-term financial goal. The next one is informed decision. Like always consider purpose, repayment, ability terms before borrowing. Means borrowing should be a well thought out decision, not something done in a hurry or under pressure. The objectives of the presentations, like to educate, like raise awareness about different borrowing methods. Second is to compare, highlights pros and cons of each borrowing option. Third is analyze, like examine impact on cost, credit score, and financial health. Fourth is recommend, like suggest smart and suitable borrowing strategies. Next is scope and relevance. Like this topic is highly relevant in India, where borrowing is rising due to growing consumer needs and easy access to credit. It covers traditionals and modern digital finance trends like BNPL, mobile EMIs, and digital loan. It especially used for like you to build financial habits, like family for smart money management, for MBA student to understand real world finance. Like it's promote informed borrowing decision in today's fast changing financial landscape. Now we come to a comparison approach. Like we compare borrowing methods using key metrics, like interest rate, cost of borrowing, then credit card, it's more, then personal loan more than a secured loan. The next is tenure, like durations of the payment, like short term or long term, or total cost, like includes interest, fees, and penalties. Ease access, like credit cards and digital loans, are quicker than traditional loans. Credit impact, timely repayment boost scores, like misuse harms it. Like this matrix helps choose the most suitable and cost effective borrowing methods. Brief history of consumer borrowing. Like first one is the traditional era. Like borrowing was informal, like mostly from local money lenders, and interest rates were very high and terms were often unfair. Second is banking expansion. After nationalizations of banks, formal loans become available, and interest rates were regulated, and borrowing became more secure. The third one is rise of NBFCs. Like it is non-banking financial companies which offered loans to those not served by bank, and credit became more accessibly, especially in rural and semi-urban areas. Next is credit card, introduced like short terms, flexible borrowing options, and popular among urban consumer for shoppings and emergency. The next is digital age. Apps like buy now or pay later and digital EMIs made borrowing instant and convenient, and paperless, fast approval, and user friendly platform. Borrowing in India is faster, like safer and more digitally driven, with more options for different needs and profile. Now, overview of key borrowing tools, like we have loans, credit cards, and EMI. So let's overview this topic. Like in short, you can say a loan is a lump sum amount borrowed and repaid with interest over a period, whereas EMI is a repayment method, usually like monthly for loans or purchases. And the third is credit card, like revolving lines of credit for immediate short-term borrowing. So let's study all this in detail. The first one is loan. Like, what is loan? So a loan is a form of like debt incurred by an individual or other entity, used for major expenses like homes, educations, or businesses. So, uh, common uses of loans are like home loans, like used to buy, build, or renovate a house or a flat, or a large amount long term repayment periods, or usually secured by the property itself. Education loans, like used for fund college or university educations, including tuitions or books and living expenses, or repayment other being after the course is completed, can be taken for studies in India or abroad. Or you can use an like a business loan, borrowed by individual or companies to start, expand, or operate a business, or may be used for buying equipments, inventory, or working capital. Or you can say about a personal loan, used for wedding travel, travel or medical expenses, and it is usually like unsecured, like a short repayment period, higher interest rate. So let's study all this. There are different types of loan, as I have already told before. So we'll study each of this in detail. The first one is home loan. Like, what is a home loan? A home loan is a money borrowed from a bank for financial institutions, like to build or renovate a house, or you can repay it in a monthly installment, that is EMI, to set numbers of years with interest. Like, the first is loan amount, like based on your income and property value. Like the bank decide how much loan to offer based on your like monthly income or your existing debt or the market value of the property. Like typically bank finance like 75% to 90% of the like property's value. The rest must be paid by you, like called the down payment. The next is like tenure, like usually 10 to 30 years. Like you can choose a repayment period from 10 up to 30 years. A longer tenure reduce the EMI but increase total interest paid. A shorter tenure means higher EMI but less interest rate overall. The next is like interest, fixed or floating rate. Like the rate is higher than the home loan, like due to higher risk. Or you and you can say you have two types of like interest, like fixed interest rate, which means that the interest rate does not change over the loan period. And monthly EMIs remains the same, providing stability. Can be slightly higher than the floating rate. The second rate is like floating interest rate. This rate can be changed over time based on the market conditions. EMIs may increase or decrease, or even cheaper in a longer run, but it is riskier. The next is like down payment, like you have to pay 10 to 25% of the total house cost upfront. Example, example, like house cost is rupees 50 lakh, but the bank offer 80%, that is 40 lakh loan. So your down payment is 10 lakh. Like this ensure the borrower has some financial stake in the property. The next is collateral. The house in the uh, house is the security for the loan. The property itself is a mortgage to the lender. Like if you fail to repay the loan default, the lender has the legal rights to seize and sell the property to recover the money. Once the full loan is repaid, the bank release the lien and the house is completely yours. The next is personal loan. A personal loan is a type of loan you can take from a bank or financial institution without giving any security or collateral. You can say the money for anything like medical expense, travel, marriage, educations, or debt repayment. Its key features is like it's no collateral needed. Like since it is unsecure, you don't have to pledge assets like your car or house. This make it ideal for people who don't own any large asset or need quick funds without lengthy paperwork. The next is fixed EMI over uh, 1 to 5 years. The repayment is done in equal monthly installment. Like you choose the loan tenure when applying, like short tenure, like high EMI but less total interest. Example, like you borrow 2 lakh rupees for 3 years at 12% interest. So your fixed monthly EMI is around 6,600. The next is higher interest rate than higher interest rate. Since the lender take more risk, interest rates are usually higher, like typically 10 to 24% per annum, depending on your credit score, incomes, and lenders. Compared to home loans, it is 7 to 10% that is secure, or car loans that is 8 to 12% they're secured. The next is quick approval. Most personal loans are digitally processed with minimal paperwork. Like if your incomes and credit scores are strong, you can get the money within 24 to 48 hours. Common eligibility criteria like you have you have a stable job or income source, like good credit score, usually like 7,000 plus, or age usually 21 to 60 years. The next point is loan amount. The loan amount you are eligible for depends on like monthly income, existing EMIs, repayment capacity, or credit score. Typically, personal loans range in India like 50,000 to 25 to 30 lakhs. The next is auto loan. An auto loan is a money borrowed from a bank or lender to buy a vehicle such as a car or a bike. You repay the loan in monthly installment, with interest or over a fixed period. The key features are its purpose. The main purpose is your auto loans are specifically designed to finance the purchase of vehicles, like new or used. You can't use the money for anything else. Then the loan amount, you can usually borrow 90 to 100% of the vehicles on roads price, which includes registrations or tax and insurance. Some banks may ask for a down payment, the part you pay yourself, especially for used vehicles. The next is tenure, like it's usually 1 to 7 years. You can short tenure is higher EMIs but less total interest, and longer tenure is like lower EMIs but more total interest paid. The next is collateral. Since it is secure loan, the vehicles itself act as a collateral. If you pay to repay, the lender can seize, repossess the vehicle to recover the dues. So the next is education's loan. An education loan is a loan taken to pay for higher education's expense like tuitions, books, accommodations, and other fees either in India or in abroad. You repay it with EMI after completing your studies, usually after a grace periods or um, its key features are like it covers tuition fees, hostels or accommodation costs like books, studies, materials, and equipments. The next is loan amount. It varies based on the course fees or the institute reputations for or whether the education is domestic or international. Its typical range is up to 10 to 15 lakhs for studies in India or 20 to 40 lakhs for studies those who are in abroad. And the interest rate usually lower than the personal loan because it's means to promote educations. The next is repayment. You don't have to start repaying the loan immediately. Like 6 to 12 months after course completions, or after getting a job, whichever comes first. This gives students time to finish their studies and find employment. The next is collateral requirement, which is often required for large loan, typically above 7.5 or above lakhs. This can be property or FD or insurance policy, etc. Like for smaller loans, especially to top institutions, no collateral may be needed. Um, The next is business loan. A business loan is a financial product offered by bank, financial institutions, or private lenders that allow individual or company to borrow money specifically, like to support or expand their business activities. This loan can be serve various purposes, like such as launching a new venture, expanding existing operations, or managing cash flow, or purchasing equipments or inventory, or even acquiring new office or factory space. Its key features, like the main purpose is the primary goal of a business loan is to help entrepreneur and companies manage and grow their businesses. Like it can be used for starting a new business, or expanding existing operations, or purchasing machinery or equipments, or hiring staff, or increasing workers. Um, and the next is loan amount. It's a it depends on the business size, incomes, and credit worthiness. Like the loan amount is not fixed and varies greatly depending on the business size. Like startups may qualify for smaller loans, while establishing companies with strong financial may get larger amount. Or the revenue and profitability, like lender assess how much income the business generate and whether it can repay the loan. The next is if it is credit worthiness, like the business, it includes the personal or business credit score, like repayment history or financial stability, or the business plan, like especially for a new venture. Like lender will evaluate the strength of your business plan. The next is tenor, which is usually 1 to 5 years. Like tenor refers to the payment period of the loan. Like business loan generally have shorter repayment period compared to a home loan. Like for short term loan, it's 1 to 3 years, often used for working capital or operational needs. Medium term loans, like 3 to 5 years, suitable for equipments purchase or expansions. All longer term loans, like more than 5 years, less common, like typically for a very large capital investment. And all this repayment is usually in the form of like EMI. The fourth is like interest rate. Like it varies by bank and business risk. And it depends on several factors like lender policies, loan amount and tenure, or borrower's credit profile. The next is collateral. It may be secured or unsecured. Like the secured loan is like required collateral, lowers interest rates, but involved risk of asset loss if you like default. An unsecured loan is like no collateral required, like based solely on your business and credit profile, like easily to apply for, but many higher interest rates and shorter tenure. The next is gold loan. A gold loan is a secured loan where you used your gold, usually in the form of jewelries or coins or bars, as collateral or to borrow money from a bank or financial institution. It is one of the fastest and the most accessible form of credit, like especially in India and the other gold rich economics. You don't have to sell your gold. You just plague it temporarily and get it back after repaying the loan. Its key features is first is the collateral, like gold items like jewelry, coin, bind. Like you plague physical gold typically in the form of gold jewelry, that is most common, and gold coin, like usually up to 50 grams per borrower, or the gold bar, like it is less common for personal loan, more for businesses or high values loan. The gold must meet the lender's purity standard, like usually 18 to like 24 carats, and this plague gold is kept safe in the bank's or lender's custody until the loan is repaid. Next, the loan amount, like usually 75 to 90% of the gold's market's values. Like the loan amount you receive is based on the current market value of the gold you plague. Like typically, lenders offers up to 75 to 90% of the gold's values, and the actual amount also depends upon on the purity and the weight of the gold, or daily gold price, or lending institutions policy. Like example, if you play gold worth rupees 1 lakh, and you may get a loan of 75 to 90 thousands, and the tenor, like it is short terms for a few months to 1 years. Like gold loans are typically short terms loan ranging from 3 months to 1 year. Like some lenders may offer flexible tenure up to 2 to 3 years, but that's less common. You must pay the loan within the chosen tenure, or reclaim your gold. The next is interest rate lower than the personal loan. Since it is secured loan, interest rates are lower than the unsecured personal loan. It's usually range between 7% to 15% per annum, depending on like depending on the lenders or loan amount or tenure or market competitions. The next is quick processing, like minimal documents and fast approval. Like gold loans are known for quick disposal, often within a few hours, like and it requires common documents like identity proof, like Aadhaar card or PAN card, or address proof, or a photograph. Since the gold serves a collateral, credit scores and income proofs are usually not required. This make it ideal for people with long credit score or no more income proof. The last is the loan against property. The loans against property all is a secured loan when you plague your residential, commercial, or industrial property as collateral to borrow a significant amount of money from a bank or financial institutions. Like unlike home loans, uh, like LAP allows you to use your existing property to raise fund for various personal or business needs without selling it. And its key features like are its collateral, its residential or commercial property. The borrowers pledge on own property, which could be like residential or commercial, residential like house or flats, apartment, or commercial like shops, office, or warehouses. Sometimes even rental or income property, or industrial property. The property must be free for legal disputes and properly registered. The lender keeps the ownership document until the loan is repaid. The next is loan amount, like usually 40 to 70% of the property's market's value. The loan usually depends on like types, locations, and the conditions of the property, and the market value and the resale potential, or your income and credit profile. Like example, if your property is valued rupees like 1 crore, the loan amount may range from 40 lakhs to 70 lakhs. And the next is tenure, it is a long term, typically like 5 to 15 years or more. Like a lap offers a long repayment period, often ranging from 5 to 15 years. Some lenders may even extend it up to 20 years, based on borrower's age and loan amount. Longer tenure, like lower monthly EMI, but higher total interest paid over time. The fourth is interest rate, like lower than the unsecured loan but higher. Like since it is a secured loan, LAP has lower interest rate than personal or businesses loan, but usually slightly higher than the home loan. Like typically rate range 9 to 14% per annum. Like, and its factors affecting interest rates are property like type and location, your credit score and repayment capacity, or the lender risk assessment. And the purpose is a wide range of uses, like fund from a loan. LAP can be used for almost any legal purpose, including business expansions or working capital needs, or children educations or medical treatment, like and wedding expenses, etc. Like unlike home loans, LAP funds are more restricted to property related to use. The next is the next is the secured versus unsecured loan. First one is the secured loan. This loan requires collateral, a asset like a house, car, or gold that the lender can take if you don't repay. Because the lender has security, this loan carry a lower risk for them. Hence, interest rates are lower and loan amount are usually higher. Example, home loans, auto loans, or LAP, that is a loan against property, or gold loans. Like secured loan is equals to like lower risk for lender, equals to lower interest rate. Talking about the unsecured loan, it is a loan that do not require collateral. They are given based on your income, your credit score, and repayment ability. Since the lender take more risk, these loans have a higher interest rate. Loan amount are usually smaller and tenure shorter. Example, personal loan or educational loan or credit card loans. Unsecured is equals to like higher risk for a lender, equals to higher interest rate. Talking about the loan tenure and amortization, like loan tenure is the total time or time to repay the loan, and the EMI is fixed monthly payment, including interest plus principal. Interest is charged on the remaining loan balance, like reducing balance, or early payment have more interest and less principal. Over time, interest decrease and principal repayment increase. EMI amount stays the same throughout the loans period. The next is eligibility, and there are certain eligibility criterias. Like basic is the age, usually up to 21 to 60 years, and the incomes should be stable, salary or business income, and the employment, like salaried or self-employed with steady income. The credit score should be like generally 7,000 plus. So for good approval chance, existing debt should be manageable. Like common documents required is like identity proof like PAN card or Aadhaar card or passport or voter ID, or address proof, proof like Aadhaar, utility bills like passport, or rent agreement, or income proof like salary slips, bank statements, income tax return, or employment proof like appointment letters for Form 16, or business registrations, or other required like passport size photo or signed applications form. You're now talking about the interest types and the bank process. So, talking about the fixed interest rate, it means like the interest rate remains the same throughout the loan tenor, like your EMI amount remains constant every month, easy to plan and budget. And its advantages like you know exactly how much you'll pay every month, and great during times of rising interest rate. But the disadvantages is usually a bit higher than initial floating rates. If market rates fall, you don't benefits, your rate stay fixed. Like example, if your rate is 10% fixed for 5 years and market rate drops to 8%, so your EMI stays based on 10%. The next is floating variable interest rate, which means like the interest rate can go up or down over time. It is linked to a benchmark, like your EMI may increase or decrease, or the tenor may adjust. And its advantages is that it's often lower starting rates. You can benefits when market rates drop. Or and the disadvantages is that like EMI can rise if interest rates goes up, and can make budgeting harder, especially for long term loan. Like example, you have a loan at 9% floating. A year later, RBI cuts repo rate, and your new rate becomes 8.5%. That's your EMI reduce. The next is hybrid rate. It is a combination interest rate, like which means it starts with a fixed interest rate for initial periods, says 2 to 5 years. After that, it switches to floating. So it is a combinations of both fixed interest and floating both. And its advantages is that it give you stability early on, when your finance might be tighter, or later you can benefit from market link rates. And the disadvantages is that you need to prepare for rate fluctuations once the fixed periods end. Like example, you get a home loan at 8.5% fixed for the first 3 years. After that, it becomes floating based on the repo rate. So, talking about the bank loan processes, like the first one is the application. It goes like this is where you initiate the loan request. The next is document submissions. Like once you apply, you must submit supporting documents so the bank can verify your identity or income or the loan purpose. The third is like verifications and credit check. Like this is where the bank access your eligibility and repayment capacity. The next is loan sanctions, like approval. If everything check out, the bank approves your loan and issues a sanction letter. The next is loan agreement signing. Like now you sign a legal agreement binding you to the loan terms. The next is disbursal, like money release. Finally, your loan amount is credited. Next is pre-repayment, like paying off a part or a full loan amount before the scheduled tenure. It helps save on interest cost, and some lenders may charge a pre-repayment penalty, but many now offer penalty-free pre-repayment, especially on floating rate loans. The next is top-up loans, like an additional loan you can take on top of your existing home loan, usually for extra fund without applying for a new loan. The interest rate usually slightly higher than the original home loans. Talking about the government schemes and the education loan subsides. In government scheme, there are PMAY, Pradhan Mantri Awas Yojana, which provides a subsidy for home loans interest for eligible first time home buyer, and it's range from 3 to 6.5% on interest for loans up to 2.5 lakhs per annum for 20 years, amid for affordable housing for low and middle income group. Talking about the education loan subsides, under schemes like central sectors industry subsidy, interest on educational loan is subsidized during the study periods for a student for economically weaker section, and it helps the reduce the financial burden while studying. Talking about the digital loan platform, it is instant personal loan via mobile apps or or apps webs, paperless process, and it is a paperless process, usually they take it from pan card or Aadhaar card or bank details, and it is a fast approval and disbursal, often within minutes, and the loan amount is 1,000 to 20 lakhs, and the tenor is 3 months to 5 years. Higher interest rate than bank, best for urgent cash needs, smaller or short terms loan, and like popular apps we have that the Credby or Nobi or Cashi, etc. Now, let's say about the take an example, and we'll discuss about its pros and cons. Like for example, we have 5 lakhs personal loan. The loan amount is 5 lakh, and the interest rate is 12% per annum, which is fixed. And the tenure is 5 years. So the EMI is 11,000, approx 11,122. So the total interest paid is 1,67,320, and the total repayment is 6,67,320. So, talking about the pros and the cons, first we'll talk about the pros, that is no collateral required, which is unsecured loan. It means yeah, you don't need a pledge any assets like property or a gold or a car. It makes it less risky for use because there is no threat or asset seize if you default. And for good for people who don't often significant asset but needs urgent funds. Like for example, you can get 2 to 5 lakhs loan based on your income and credit score, without giving any security. The next is quick approval and dispersal, often within 1 or 2 days. Like most people, loans are processed quickly, especially within with online applications. Many banks offers instant approval or dispersal within 24 to 48 hours if your documents are in order, or ideal for emergency needs like medical expenses or urgent travel. Some fintechs lenders can even transfer fund within minutes, like if you are pre-approved. The next is fixed EMIs, like easy to plan monthly budget. Like means personal loan typically come with a fixed interest lane and fixed monthly EMIs. So you know exactly how much to repay each month, which helps with like budgeting and financial planning. So no surprises and payments like amount during the loan tenure. Like for example, a 3 lakh loan over 3 years, like within 12% interest, will have a fixed EMI of around like rupees 10,000 like month. The next is flexible use. Can be used for marriage, travel, or medical, etc. Um, uh, you can use a personal loan for any purpose, like wedding expense, travel or vacations, or home renovations or medical emergency. No need to tell the lenders like how you are spending the money, unlike a home or a auto loan. It's one of the most versatile types of loan available. The next is top up loans options after timely repayment. If you repay your EMI on time and maintain a good record, like lenders may offer a top up loan, extra loan on top of a current one. Like this saves your time and you don't have to reapply from scratch. Like often comes with a lower processing time and sometimes like better terms. Like example, if you have repaid 1 lakh out of your like 3 lakh loan, you might be offered 1 to 2 lakh top up. Next, the next is the cons of the personal loan. Like first one is the higher interest rate than secured loans. Personal loans are unsecured, like the lenders take one more risk since there is no collateral. To compensate their large interest rate, typically like 20 to 24%, depending on your credit profile. In contrast, like secured loans, like homes or auto loans, may have interest rates starting from 6 to 9%. Like for example, 5 lakh personal loan might cost you 1.5 lakh in interest over 5 years, whereas a home loan can of the same amount might cost significantly less. The next is strict eligibility criteria, lenders prefers borrowers with with stable which person who have stable income or strong employment history, and whose credit score can be like above 7,000. Like if your credit score is low, your income is irregular, your loan may be rejected or approved at a very high rate. Or some employed applicant often face stricter and the rejection can also affect your credit score if you apply too frequently. The next is penalty for late payment or repayment. Like missing an EMI result in the late repayments fees can also attract a penalty interest rate. Some lenders also charge a repayment like for foreclosure penalty if you try to repay the full loan early. This limits your ability to save interest by closing the loan before time. Always check the hidden charge like in the loan agreement. Fourth is the negative impact of the credit score. Like if you miss EMIs, like every missed or delayed EMIs is reported to credit CIBIL. Like even one missed payment can lower your credit score and affect your ability to get future loan for credit cards. And repeated default can lead to loan recovery actions or legal notice. Like if you miss multiple EMIs, you could be classified as a defaulter. And the next is short tenor, higher monthly EMIs. Like personal loans generally have a shorter tenor, like 1 to 5 years. This means your monthly EMIs are higher compared to a long-term loans like home loans, which are stretched from 20 to 30 years. Like higher EMI can strain your monthly budget, especially if you have other financial obligations. Like example, a rupees of 5 lakhs loan over 3 years will have a much higher EMI than if it were stretched over 10 years, which isn't usually allowed for a personal loan. Then next is loan repayment and default impact. The first is talking about the loan repayment. Like you must repay your loan in EMIs on time. Like timely payment helps build a strong credit score and loan eligibility in the future. You can repay as per the EMI schedule or with the pre repayment like part or full to reduce interest burden. About the talking about the loan default impact, like this credit score has dropped like 50 to 100 points per missed EMI, like, and there is extra charges like late fee, penal interest, as I've already told before, like bounce charge, and recovery actions like calls, legal notice, possible lawsuits, and also asset seizures like for secured loans like home or car. CIBIL stains like visible for up to 7 years, and the future loan is harder to get and higher the interest rate. How to avoid how to avoid the default, like choose AMI you can afford, and also use auto debit for one time payment. Also communicate with your bank if you are facing financial stress. They may offer like restructuring or etc. Now, what is EMI? Like talking about EMI, EMI is also called as like equated monthly installment. Is a fixed amount you repay every month. In plain terms, when you borrow money from a bank or lender, you usually agree to pay it back in parts, not all at once. And EMI is one of those parts. Like it includes parts of the principal, the original amount you borrowed, interest, the extra money the lender charged for giving you the loan. Each month you pay a fixed amount until the loan is fully paid off. We have a formula like EMI is equal to P into R into 1 plus R whole raised to N divided by 1 plus R whole raised to N minus 1, where P stand for principal loan amount, R stand for like monthly interest rate, and N stand for number of monthly installment. Now let's take an example like principal is rupees 5 lakh and your annual interest rate is 10%, and your loan tenor is like 5 years. So first we have to calculate like monthly interest rate, which is R is 10 divided by 12 into 100% equals, we have a answer like 0.000833. Now the steps 2 is the number of installment, which is 5 into 12 equals to 60. Uh, the main is summary is that the interest drop each month as you repay principal. You pay less interest overall. Like EMIs are consistent, but a composition shift from interest heavy to principal heavy. The next is like reducing versus flat rate plus no cost EMI. Like talking about the reducing rate, interest is calculated on limiting loans balance every month. As you pay off the principal, interest for the next month reduce, and the monthly EMI stay roughly the state, but the interest portion decrease and the principal portion increase over time. More accurate and usually cheaper than the flat rate. Talking about the flat rate, a flat rate charge interest on the entire original loan amount for full tenor, like making EMI simple and fixed, but often result in higher total interest payment compared to a reducing balance method where interest decrease over time as you repay the principal. The next is no cost EMI. Talking about it, the total cost of the loan is effectively zero interest. Uh, you can say that you pay the product actual price in equal monthly installment without extra interest, as the interest is typically absorbed by the seller or brand as part of promotion, like making it attractive financial option if there are no hidden charges. um Now let's see the table. Like we are comparing flat rate EMIs, like reducing rate EMI and no cost EMI, where the interest calculation is full and full principal throughout. And in reducing, we have rate EMI, we have outstanding principal, and in no cost EMI, we have low interest, where the total interest paid in flat rate is higher, and in reducing rate EMI is lower, and in no cost it is zero, where the EMI amount is a fixed equal part, and in reducing rate EMI it is fixed total and interest reduced, and in no cost it is fixed equal parts. The total payment in flat rate is principal plus high interest. In reducing rate EMI, it is principal plus less interest. And in no cost EMI, it is principal only. The transparency is that it is in flat rate it is simple but less accurate. In reducing rate EMI it is more accurate, and in no cost EMI it is very transparent. So talking about the credit card gadget offers, like EMI on credit cards allows you to break down large purchases into affordable amount, like and you pay fixed monthly amount instead of full bill at once. Where interest rate varies, sometimes no cost EMI is offered, and the bank pay charges processing fees or interest check terms, helps spread out cost or expensive buy without a separate loan. In short, in summary, you can say that a credit card allows you to like break down large purchases into affordable monthly payment, with or without interest, making it easier to manage big expenses. But it's important to check for hidden interest fees and credit limit card impact, before opting it. Talking about the gadgets, EMI on gadgets and electronics, like it is the seller partners with bank or NBFCs like to offer EMIs on gadget, and you pick a tenor, often 3 months or 6 months or 9 months or 12 months, and pay equal EMIs. And there is no cost EMIs offers are common during sales, like no extra interest, and it make expensive gadget affordable and increase sales. Like how online purchases are financial, like via EMIs. EMIs options appears during checkouts on e-commerce sites, or you select EMI, choose your bank card and repayment tenor. Or you can say like bank or NBFCs pays the seller upfront. You repay the bank monthly through your credit cards or statements, or it helps buy expensive items without paying all at once. Talking about the expensive, if misunderstood, in conversions, like charges fees applied when converting one currency to another, like often adding extra cost to international transactions. Or we have hidden fees like unexpected or undisclosed charges that aren't clearly stated upfront, increasing the total cost. Or the default and penalties like extra cost or consequences incurred when a borrower failed to make payments on time. And we have high interest like rates are borrowed money that significantly increase the repayment amount over time. And lack of clarity like poor or confusing communications of terms and conditions that can lead to misunderstanding or financial loss. Like how to avoid EMI surprises, like uh, check effective interest rates and fees before opting for EMIs, and read terms carefully to understand penalties if we have, or choose reducing balance EMIs plans when possible. Always pay on time to avoid penalties. And for no cost EMIs, confirm it interest is included in the product price or not. uh Real time EMI use, we can like let's take an example, like student buy a 60,000 laptop on 6 months, which is no cost EMI. So the total cost is 60,000 rupees, whereas EMI tenure is 6 months. So the monthly EMI is 60,000 divided by 6, that is 10,000 per month. So no extra interest or charge. So the student pay rupees 10,000 every month for 6 months, making the laptop affordable without paying all 60,000 altogether. Now we have online EMI platforms like Z Money, which is no cost EMI, no credit card needed. Or we have Lazy Pay, like pay later after 15 to or 30 days, or convert to EMI. Or simple like one bill every 15 days. Or we have Amazon Flipkart, like card based or no cost EMI options. Or Bajaj EMI cards, EMI cards for online offline shopping. Or we have Paytm postpaids, like instant credit for bills and shoppings. And talking about the pros and cons of this, like we have instant approval, and no credit cards is needed, like it in many cases, like and it also flexible tenures, like helps build credit history. Cons is like it is high interest if not no cost, like, and we also have a late fees, credit score impact. And overuse can lead to debt also. Talking about the advantages and disadvantages. Advantages is that it break big payment into smaller monthly amount, and there is no need to pay full cash upfront, and no cost EMIs options save on interest. And it also help manage monthly budget and cash flows. On time payment improve your credit scores also. Talking about the disadvantages, like monthly EMI becomes a fixed financial burden also. uh, it may include like hidden charges or interest, and missing payments leads to penalties or and credit score damage, or less flexibility for other expenses or saving, or easy EMIs offer can tempt you to overspend. Role of NBFCs in like EMI. It offers EMI financings without a bank. They partner with online and offline retailers to provide easy EMIs for gadget, appliance, or educations, etc. And it offer quick approval, like no cost EMIs and flexible repayment option. Like example, we have two like Bajaj Finserv, like EMIs card, no cost EMI used in many stores. Or we have a capital float, like online buy now pay later on Amazon, Unacademy, etc. Talking about the smart tips, first is choose no cost EMIs to avoid extra charges. Like no cost EMIs let you pay only the actual product price in installment, no interest added. The next is compare tenure and interest rate. Like a longer EMI tenure means smaller EMI, but more interest rate. A shorter tenure has higher EMI, but saves on interest. Whereas always compare offers from different banks or cards. Third is watch for processing fees or hidden charges. Like many EMI plans includes processing fees or like repayment penalties or GSTs on interest or fees. This can increase the real cost even if the interest rate seems low. And and before doing read the terms and condition before confirming any EMI options. The fourth is don't take too many EMIs at once. Like multiple EMI can stain your monthly income and affect your ability to repay. Bank checks your EMI before approving new loans. If you are like overburdened, future loans or credit card limits may be affected. Like we should like keep your monthly EMIs under 40% of your take home salaries. The next is use EMI for essential or impulsive buy. Like EMI make it easy to spend, but that doesn't means you should. And it use of high value needed, for example, for medicals or educations or essential electronics. And to avoid using EMI for things you can easily save up for, or you don't need urgently. The sixth is always pay EMIs on time to protect your credit score. Like missed or delayed EMIs are reported to credit CBIL or experience. Now, talking about the credit cards. What is credit cards? So, a card issued by bank allowing you to borrow money up to a limit for purchases or cash withdrawal. It's like a a credit card is a financial tool issued by a bank or financial institutions that allows you to borrow money up to a pre-approved limit to make purchases or withdraw cash. It's like a short-term loan that you repay later, sometimes with interest. And it's like a and how does it work? When you use a credit card, the bank pays the merchant upfront. Like later you get a monthly bill from the bank, which you need to pay either in full or partially. Like minimum amount, like if you paid in full, interest charge on the remaining balance. So we have some types of like credit cards, like gold and platinum cards, which is used for premium card with higher credit limits and extra perk, like for airport lounge access or better rewards. And co-branded like cards, these are cards which is tied to specific brands or company. Example like airlines card or retail stores cards, like offering special they offer special discounts or points to those brands. The third is like secured card. It requires a fixed deposit, has collateral idle for those building or rebuilding credit history. The next is student card. It is tailored for student with lower credit limits, and it is specified like eligibility to help build credits. Talking about the billing and the grace period, it is typically lasted for over 30 days. Like after the billing cycle ends, you receive a statement showing all transactions and the total amount due. The next is about the grace period. this is a time from the end of your billing cycle until your payment due date, like usually 20 to 25 days. If you pay your full outstanding balance within this period, no interest is charged. So let's take an example, example of this, like billing cycles end at May 31, payment due is June 20. So you pay full money by June 20 with like no interest. So the pay late or partial equals to like interest change from purchase date. Talking about the revolving credits and minimum due traps, like revolving credits are those, like is a type of credit that lets you borrow or repay or again up to a certain limit, like without needing to apply for a new loan each time. Like when you don't pay like full balance, the unpaid amount is carried forward and you are charged interest on it. This is like a revolving credit. And talking about the minimum due, credit card like asks you to pay a minimum amount, usually 5 to 10% of like balance. Paying only the minimum leads like high interest accumulations or a long time to clear the debt or like increase total repayment. So let's take an example. Like balance, you have $1,000. Interest is 24% per annum. Like paying full is no interest, like which is debt cleared quickly. And paying minimum is you take years to pay off interest. Add up to hundreds. So bottom line is that you always pay full or as much as possible to avoid in heavy interest. EMI on talking about the EMI on credit card and charges. Talking first, we'll talk about the EMI on credit card. Like a faculty that lets you split big purchases into smaller monthly payment, like 3, 6, 12 months, instead of paying the full amount at once. Um, so let's take an example, like you buy a product, example of 30,000 TV rupees. It converts into EMI by apps or calls or a checkout, and you pay monthly installment with or without interest. So there are hidden charges also. Let's see one by one. Like the first one is the processing fee. This is a one fee like the lender charge when you're giving you the loan. Example, like if you take a loan of 1 lakh and the processing fees is 2%, you'll be charged rupees 2,000. And the amount may be deducted from the loan amount or added to your cost. The next is interest, which can be up to 13 to 4% per annum. Like this is your yearly cost of borrowing. It means for every rupees 100 borrowed, you might pay 13 to 24 rupees in interest per year, depending on your rates. And it is higher interest equals to higher total repayment. The third one is pre-closure fees. If you want to repay the loan early before the full term, you might be charged a fee. For example, if you still owe rupees 50,000 as pre-closure fee in 4%, you'll pay 2,000 extra. The next is late fees and GSTs. Like if you miss any EMI payment, you will be charged a late payment penalty. Like GST is added to various charges like processing fees or late fees, etc. So that's it from my side. Thank you all for listening so patiently. Once again, thank you.